Hello everyone and welcome back to the sessions on financial management. Friends, in this class of financial management, we are continuing with the basics of financial management and consider this as the second lecture with respect to basics of financial management. So in the previous class, if you can recall, we have learnt income statement, how to present an income statement, and if you can recollect, we have made an income statement starting with sales and going right up to the level of earnings per share and even the level of retained earnings. As I told you in the previous class that income statement can be presented in different ways depending upon what exactly you want to arrive at. Today what we are going to learn is income statement for determining cash flows. So the first question that a student generally will have in his or her mind that, sir, what are these cash flows? Basically, when you start a business, you end up earning profits every year. But the profits every year should be in the form of cash flows. That means you should be having cash inflows every year that indicates that yes, your profit is being earned in monetary form. That money should come in. But the amount of profit may not always accurately match with the amount of cash flows. Do you know why? Because there may be certain items of expenses which by their basic nature are non-cash expenses. Do I need to remind you what are those non-cash expenses? Non-cash expenses could be depreciation and amortization. So when you are computing the amount of cash flow, you have to take care of one thing, that the amount of depreciation and amortization which are representing non-cash expenses will be something which will create a big difference between the amount of profit that you earn and the amount of cash flows that you are generating. First of all, please let me explain one thing, that cash flows are so important. Suppose I ask you to invest 10 lakh rupees into a business, okay, and I don't give you any money back. You have invested 10 lakhs in a business and I come and declare you by end of first year, wow, fantastic, you earned a profit of 2 lakhs this year. So now your capital is 12 lakhs. Next year I again come and declare, wow, this year you have earned even higher profits. You have earned profit of 3 lakhs. So now your capital amount is 15 lakhs. Every year you are earning profits and your capital is increasing. But I don't give you any money in lifetime. One day you do not exist. What will happen to that capital? Nothing happens. Basically, you should always be knowing one thing, that if your money is not received, someday you would want to encash your profit. If you are investing some money today, you want that money back someday. Can we agree on that? That today if you are investing some money, of course you may keep patience and let that money grow, but someday you want your money back, right? So everything is about cash flow. Suppose I put it forward little differently. Suppose I tell you that, sir, there is a mutual fund scheme and you invest 1 lakh every year for 5 years in that mutual fund, and then that money will keep growing. And you ask me a question that when will I get back that money? I say you will never get back that money. That money will be there with the mutual fund company. It will keep growing. It will keep growing. You will never get back that money. Will you invest your money? So you are not growing a tree over there, right? That you are happy watching a tree growing, right? You are investing your money with an intention of getting it back someday with some income included in that capital, with some income included in that money, correct? Therefore, when are we going to receive that money and how much money we are going to receive, that time profitability and everything is kept aside. We are focused on the computation of the cash flow, how much money we will earn in the form of cash. So please understand, when you are attempting to compute that when you are operating a business, how much cash flow you will generate every year, your distinguishment of expenses into operating and non-operating may not be required. Whether the expense is operating or non-operating, if it is a cash expense, it will have to be paid. So here the bigger point of difference which becomes more important will be classification between expenses which are cash expense and non-cash expense. So when you have to present an income statement for determining the amount of cash flows, how should you go with that? Let me explain you directly with that statement, and I would want you to note it down. And you first begin with this heading: income statement for determining annual cash flows. Please write this heading: income statement for determining annual cash flows. Under this heading you please write, again starting with sales less variable cost, you arrive at contribution, you subtract cash fixed cost. You subtract cash fixed cost. Here I did not mention cash operating fixed cost. Here it is cash fixed cost. All cash fixed cost, whether operating or non-operating, everything should be subtracted from here. Now you tell me, when you are subtracting all types of cash fixed cost, even interest will be subtracted over here. So when you are writing this line, that is less cash fixed cost, you may write within brackets over here, including interest if any, including interest if any. And what we will arrive at is known as PBDT or CFBT. So please write that as PBDT or CFBT. Now you might be wondering, what is this PBDT and CFBT? I will give you the full forms in a while. PBDT means, this term PBDT means profit before depreciation and tax. Here I am assuming the word depreciation, it is inclusive of amortization of intangibles. Means when I speak of depreciation over here, I am speaking of depreciation and amortization, it is implied. So logically, do you know, from sales when we subtracted variable cost, we arrive at contribution. Then we are subtracting cash fixed cost, means all fixed cost other than, all fixed cost other than depreciation and amortization. So the profit that we get will be profit before depreciation and amortization, or we can say profit before depreciation, just profit before depreciation. But because we have yet to subtract tax, we will call this as profit before depreciation and tax. Now this is also known as CFBT. CFBT stands for what? Cash flows before tax. CFBT stands for cash flows before tax. PBDT and CFBT will always be same amounts. How it will be same amounts? Logically, I have yet to explain that with examples. Keep patience, I will come to that point as well. So from profit before depreciation and tax, you cannot first subtract tax. First you will have to subtract the amount of depreciation, including the amount of amortization if any. So from PBDT you subtract depreciation including amortization, and then what you get is profit before tax. This profit before tax, it is basically the taxable profit. On this amount the tax will be charged, and from that when you subtract tax you get profit after tax. And then this is the profit after tax. We want to arrive at the annual cash inflows. So whatever depreciation you have subtracted, you should now at the end add it back to arrive at annual CFAT. If CFBT was cash flows before tax, CFAT will be cash flows after tax. Now the moment I mention this statement in front of you, I already know that lots of students will be having doubts in their minds that, sir, why are you first subtracting depreciation and then again adding it back. Why don't you just subtract tax and get done with it? What is the sense of first subtracting something and then again adding it back? If you have to add it back again, why in the first order, sir, are you subtracting this? Why are you doing this? My dear, keep patience. I told you, everything logically is yet to be understood. Keep patience. First note down this statement, and then definitely in a short while I'll explain you why we are doing all this. And believe me, we are doing nothing without reasons. Without logical reasons, we are not doing anything. And let us now try to understand this income statement, basically to land up at amount of annual cash flows after tax. Once again, let me tell you, annual cash flows after tax means what is the amount of cash that a business can generate each year. That is what we call as annual cash flows after tax. That means capacity of a business to generate income in the form of cash, purely cash income, and that to net of everything, net of tax, final net amount of cash flow what a business can generate, which will be available for the company for its growth, dividend, etc., etc. That amount of cash flow we are trying to find out. For this purpose, let us do one thing. Let us take example of my own business. Now what happens in my business? In my business, students can purchase my video lectures. We provide them software. We provide them this kind of textbooks, nicely designed colored textbooks, and the students will pay the fees, and we provide them this material, the video classes and all other things. So do you know, once I get one order from a student, I'll have to give them a set of books which will cost me some money. I'll have to provide them encrypted videos. That encryption will cost me something. I'll have to send the books through courier. That will cost me something. Now, the charges of courier, will it be variable cost or fixed cost? Think logically. It can never be fixed cost, because courier charges will vary with the number of orders that I have received. Correct? With the number of orders that I have received. The books cost, the cost of these printed books, it will again vary with the number of orders that I am dispatching, right? The number of orders I receive, only that many books I have to provide. So there will be some components in my business which are variable cost purely. On the other side, there may be some components in my business which are fixed cost. Fixed cost could be rent of this studio from where I operate. It could be maintenance charges for all these equipments that I am using in my studio. These are expensive equipments through which these recordings are done. Through these equipments we are carrying out online classes. Now there will be heavy depreciation of these equipments also, but depreciation is basically a non-cash expense. Okay, so let us talk in figures so that things are clearly understood. Let us assume that one unit of this video class along with books is sold for rupees 5,000. So one unit is sold for 5,000. The variable cost of one unit is 3,000. So I am selling one unit for 5,000 and the variable cost is 3,000. So simple thing is, with each sale happening at my end, you tell me how much contribution do I generate from my business every year. If I am selling say 1,000 units, each unit will generate income for me, and each unit will also require some cost to be incurred. So the cost incurred on each unit, I told you it is 3,000, and the revenue that I am getting for each unit, it is 5,000. So 5,000 minus 3,000, each unit is contributing rupees 2,000. And as I told you, every year if I am making sale of 1,000 such units, 1,000 multiplied by contribution per unit of 2,000 do you know the total amount of contribution that arises in my business will be rupees 20 lakhs. Can we agree? Rupees 20 lakhs. That is how we got 20 lakhs. Sale price per unit 5,000 less variable cost per unit 3,000. So contribution per unit will be rupees 2,000. That will be multiplied to the number of units that I am selling, that is 1,000 units. So 1,000 units multiplied by rupees 2,000 will give me 20 lakhs of contribution every year. Now let me tell you, you can alternatively compute the contribution the way it is appearing on the income statement, that you first take the total sales. So can we assess the total amount of sales that my business has? It will be 1,000 units multiplied by rupees 5,000 each unit. So 1,000 multiplied by 5,000 will give you what? 50 lakhs less variable cost. It will be 1,000 units into 3,000 per unit. So that will be 30 lakhs. So 50 lakhs of sales less 30 lakhs of variable cost. The amount of contribution will be obviously 20 lakhs. Correct? The amount of contribution will be 20 lakhs. So you can land up at contribution amount either way, whatever is comfortable. So once you arrive at contribution, we have to first subtract all the fixed cost except depreciation and amortization. All the fixed cost including interest. So I have suppose borrowed money for funding my business. So even the interest cost will be subtracted. So I am going to subtract all the fixed cost except depreciation and amortization. So let us assume in my business all fixed cost including depreciation and amortization, it is 12 lakhs. But I don't want to subtract all of that amount. So I will exclude depreciation and amortization. Depreciation and amortization every year it is 2 lakhs. That means the cash fixed cost will be 10 lakhs. So from 20 lakhs of contribution, I will first subtract the amount of cash fixed cost, which is 10 lakhs. So I get PBDT, that is profit before depreciation and tax. So profit before depreciation and tax will be 10 lakhs. Now I will subtract depreciation. Amount of depreciation is 2 lakhs. Depreciation and amortization, I am just clubbing up both of these. Depreciation and amortization in my business, it is 2 lakhs every year. So from 10 lakhs of profit before depreciation and tax, I first subtract 2 lakhs to arrive at profit before tax. This profit before tax will be 10 lakhs minus 2 lakhs, that is 8 lakhs. When I land up at 8 lakhs, then I come to know that 8 lakhs is my taxable profit. So I will be computing tax on that 8 lakhs of profit, because that is my net profit before tax. Now when we are going to compute the tax, we need tax rate. Let us assume that tax rate is 30%. So what will happen in my business? There will be taxation arising as 30% of that 8 lakhs. 30% of 8 lakhs is how much? 2,40,000, right? So 2,40,000 will be the amount of tax that I'll have to pay. Now understand, tax I will have to pay from my pocket. I subtract that also. So what is the final amount of net profit that remains with me? The net profit after tax. Net profit after tax in my business will be how much? 5,60,000. That is 8 lakh minus 2,40,000. It is 5,60,000. Alternatively, you can also use your simple common sense. If 30% is the rate of tax, then profit after tax will be 70% of profit before tax. Are you people understanding what I am trying to say? If tax rate is 30%, we can directly say that profit that will remain after tax will be 70% of the profit before tax. So profit before tax was how much? Profit before tax was 8 lakhs. 70% of that profit will be 5,60,000, or profit before tax minus the amount of tax that will also give you profit after tax. Now what we have to do is add back the amount of depreciation, that is 2 lakhs. So 5,60,000 of profit after tax, adding back depreciation of 2 lakhs, it will give me annual cash flow of 7,60,000. Now you might be again wondering that, sir, what is this that you are explaining? A student would say, sir, we had this query in our mind, that why are you subtracting depreciation first and then again adding it back? What is this cash flow? We are not understanding anything, sir. Come on, you have just conveyed some figures along with this statement and we still don't understand anything. I'm knowing one thing, that this is happening there in your mind. But as I told you, everything happens at its time. Nature takes its own time to make things happen, and therefore I am part of this nature. I will take my own time to make this thing clearly fit into your mind, and what you need to do is you just have to sit with patience and just keep listening to me. With these figures that I have included by way of this example, do you know what will be the advantage? That now when I am talking about anything, I am not talking blankly, I am talking with facts and figures. So let us now try to understand the cash flow concept in my business. So all the facts and figures I have given to you. Okay. Now I am just repeating the same thing with more sensible understanding. In my business, I have sold 1000 units. The selling price per unit is 5,000. 1000 multiplied by 5,000, it will be my total sales, which is 50 lakhs. 50 lakhs actually will come to my bank account, because what happens in my business, a student will first pay the fees and then I will provide the product. That means, can we agree on one thing, that 50 lakhs of my sales would have been actually a receipt in my bank account, a deposit in my bank account amounting to 50 lakhs. That means that much money my business has actually received in cash. When we incur variable cost, how much is variable cost? Rupees 3,000 per unit multiplied by 1000 unit, that is rupees 30 lakhs. That variable cost also we have to pay in cash. So visualize one thing, that in my bank account there was a deposit made, amounting to 50 lakhs. From that we have removed, subtracted 30 lakhs of payments made towards variable cost. So there was 50 lakhs of cash inflow, 30 lakhs of cash outflow. Sales minus variable cost, the final amount of contribution, that is 20 lakhs, would now remain in my bank account. Correct? Can we agree that 20 lakhs will be now remaining in my bank account? But that is not the end of the story. I have yet to pay for those fixed costs also. So fixed cost in my business, I told you, it is 12 lakhs. But that 12 lakhs includes 2 lakhs of depreciation and amortization. So I don't have to pay depreciation and amortization. Correct? I don't have to pay depreciation and amortization. I have explained this to you in the previous class along with the journal entries, that every fixed cost like salary, rent, insurance premium, administrative charges. How do you pass journal entries for this? Salary account debit to cash or bank, then insurance premium debit to cash or bank, then you have administrative charges debit to cash or bank. But when it comes to depreciation or amortization of intangible assets, depreciation will be debited, but you don't have any cash outflow. So you don't pass an entry as depreciation debit to cash. It is depreciation debit to that fixed asset on which the depreciation is arising. So friends, from the viewpoint of profit and from the viewpoint of cash flow, let us have a comparative analysis. So once again, please understand this way, that I have generated sales of 50 lakhs and that much money is actually coming as inflow in my bank account. Correct? So one side I have the amount of sales as 50 lakhs, and in my bank account there is a cash inflow of 50 lakhs. Then I pay for variable cost 30 lakhs. So my bank balance of 50 lakhs gets reduced by 30 lakhs. So I have contribution of 20 lakhs, sales minus variable cost, 50 lakhs minus 30 lakhs, contribution 20 lakhs, same amount of that money is actually lying in my bank account. Now I have total fixed cost of 12 lakhs in this example, but that 12 lakhs includes 2 lakhs as depreciation. So I will not subtract all 12 lakhs, I will subtract only 10 lakhs. So when I subtract 10 lakhs, it is basically cash fixed cost. So contribution less cash fixed cost, it will not give me the direct amount of profit. It is definitely a profit, but profit before charging depreciation. And of course we have not paid tax, so we will call that profit as profit before depreciation and tax. So that segment of income statement reads like this: contribution 20 lakhs, less cash fixed cost 10 lakhs, profit before depreciation and tax is 10 lakhs. Look at the cash flow. I had sales revenue of 50 lakhs coming in my bank account, variable cost going out of my bank account, contribution of 20 lakhs now remains in my bank account. Out of that 20 lakhs of contribution also, I will have to pay for the cash fixed cost, that is 10 lakhs. So in my bank now what remains is a cash amount of 10 lakhs. So now visualize one thing. One side you have profit before depreciation and tax amounting to 10 lakhs. Another side you have cash flow in the bank, that is also 10 lakhs. So what you are calling as profit before depreciation and tax, that same thing is the amount of cash flow but before tax. Now cash flow cannot be called as cash flow before depreciation and tax because depreciation will not result into any cash outflow. So logically from that 10 lakhs there is only one cash outflow that is going to happen. What is that one cash outflow? That is tax. So logically cash flow before tax, that is 10 lakhs in my example, is always going to be same as profit before depreciation and tax. One thing that you should conceptually conclude at this point, because this is going to help you out ahead in the journey of learning financial management, that when we say profit before depreciation and tax, it is actually cash flows before tax, because everything we have subtracted. We have subtracted all variable cost, we have subtracted all those fixed cost which requires cash outflow. When variable cost and fixed cost and interest, everything subtracted, only one thing now remains to be subtracted, that is tax. The tax will be subtracted from CFBT, that is cash flow before tax. Less tax will give you cash flow after tax. But the problem is, from cash flows before tax you cannot directly subtract the amount of tax. Why? Because cash flow before tax is not your taxable profit, because by profit angle it is indicating profit before depreciation and tax. So when I say profit before depreciation and tax, it is not your taxable profit. Income tax law, I repeat, income tax law will always permit you to charge depreciation, and after charging depreciation, whatever profit you get, only on that profit you have to pay tax. So to compute my taxable profit, obviously I have to first subtract depreciation. If I don't do that, I will not even know how much is the amount of profit on which I have to pay tax. So understand this point. When we land up at profit before depreciation and tax, same amount is lying in my bank account. 10 lakhs, 10 lakhs. Profit before depreciation and tax, 10 lakhs. Cash flow before tax, 10 lakhs. Now first I subtract depreciation. When I subtract depreciation of 2 lakhs, profit before depreciation and tax 10 lakhs minus depreciation of 2 lakhs, profit before tax is only 8 lakhs. So my profit got reduced from 10 lakhs to 8 lakhs. But do you know, the money lying in my bank doesn't get reduced by a single rupee, because what we have charged is depreciation. It is a non-cash expense, so it does not reduce the amount of cash flow. Cash flow in my hand is still 10 lakhs, but profit before tax is only 8 lakhs. First time we are finding that the amount of cash flow in hand and amount of profit, they are different. Why they are different? Because first time we have charged an expense which was a non-cash expense. So I repeat, profit before depreciation and tax was 10 lakhs, which we call as cash flow before tax, 10 lakhs. I subtract 2 lakhs of depreciation, profit before depreciation and tax of 10 lakhs. Now reduced by 2 lakhs, it becomes profit before tax of 8 lakhs. But my cash flow remains intact. Cash flow doesn't change. Cash flow remains 10 lakhs. But now I have finally landed up at the amount of taxable profit, that is profit before tax, amounting to 8 lakhs. Now consider the fact that tax rate is 30%. So on 8 lakhs you will charge 30% tax. 30% of 8 lakhs is 2,40,000. When you subtract that tax, you will have to pay that tax in cash, correct? So that money will again flow out of your bank account. So logically, how much money was there in your bank account before paying tax? 10 lakhs. What is the amount of tax? 2,40,000. 10 lakh minus 2,40,000. What will be the remaining money lying in your bank account? It will be 7,60,000. 10 lakhs minus 2,40,000, 7,60,000. That 7,60,000 is cash flow after tax. Cash flow after tax. But the problem is, we cannot do that because for computing the correct amount of tax, we need to know the taxable profit. Therefore, we follow this pattern of presenting income statement where we arrive at profit before depreciation and tax 10 lakhs. We first subtract depreciation of 2 lakhs. Profit before tax will be 8 lakhs. Then subtract tax of 30%, that will be 2,40,000. We get profit after tax as 5,60,000. But because we have subtracted one expense in the name of depreciation which did not result into cash outflow, we add it back to get the amount of cash flow that is there in my bank. So annually, if I look into what profit I have earned, it is 5,60,000. But annually, how much cash flow did I generate? It is 7,60,000. Whenever non-cash expenses like depreciation and amortization will exist, annual cash flow amount will always be greater than the net amount of profit after tax. So friends, two things we have to understand over here. What is the meaning of this annual cash flow after tax? Second thing, why are we computing this? I have actually explained you in detail what is the meaning of this annual cash flow after tax. That annual cash flow after tax, by calculation, it is coming to rupees 7,60,000, and that is basically the amount which we are able to generate as a cash inflow, net of everything, net of tax from our business. Why are we computing this? For all your capital budgeting decisions, you are going to use this information about annual cash flows, because what will happen today, if you are putting your money into project, any project, for example, some years back I have purchased this camera through which my lectures are getting recorded. Do you see a small microphone over here? I have purchased this microphone. I have purchased a recording software. I have acquired an encryption software. I have acquired all other tools which are supporting my business operation. So understand one thing, all these assets will depreciate someday. When these assets are depreciating, it will definitely involve an expense which is not a cash outflow. But do you know what did I do? To acquire all these assets, the big amount I have invested at that date when I started my business, right? So that amount when I have invested, I will be gradually depreciating that same thing over the life of the project. So that day I have made some investment. Now I want to see how much money my business is giving me every year. That is, I want to arrive at annual cash flows. That is why we are computing this kind of annual cash flows. So with this whole understanding, what I will do further is I will give you some examples to better understand this whole cash flow calculation. So let us go ahead and deal with some examples over here. Before we start dealing with examples, I want you to note down the full form of these short forms that we have used. PBDT stands for profit before depreciation and tax. CFBT is cash flow before tax. PBT is profit before tax. PAT is profit after tax. CFAT is cash flows after tax. Let us go ahead and now take up some examples, beginning with the first example, example number 1. It says consider the following example: sales rupees 80 lakhs, cash fixed cost rupees 20 lakhs, annual depreciation 10 lakhs, tax rate 30% and variable cost are informed as 50% of sales. Determine cash flows after tax, CFAT. So when you are starting with this income statement, the first component will be sales less variable cost, which is 50% of sales. So 80 lakhs minus 40 lakhs will give you contribution of 40 lakhs. Then subtract cash fixed cost amounting to 20 lakhs. That will give you profit before depreciation and tax amounting to 20 lakhs. Then subtract the amount of depreciation, that will be 10 lakhs. You will get profit before tax amounting to 10 lakhs. Tax rate is given as 30%. So 30% of 10 lakhs will be 3 lakhs. You arrive at profit after tax as 7 lakhs. And now add back the amount of depreciation, that is 10 lakhs, and you get annual cash flows after tax amounting to 17 lakhs. Let us move ahead and take up another similar example. So I want you to write down this example, that is example number 2, and here we go with this. X Limited started a project which requires initial investment of rupees 40 lakhs. The project has a life of 5 years without any scrap value. Depreciation is allowed on SLM basis. Amount of annual sales is rupees 1 crores. Variable costs are 60% of sales. Fixed cost other than depreciation is rupees 20 lakhs every year. Tax rate is 30%. Determine the annual cash flows after tax. Now when you are handling a question like this, what you need to understand first of all, sometimes the amount of depreciation may not be given to you directly, but you can always compute the depreciation. Can you notice the initial investment required in the project assets will be rupees 40 lakhs. The project has life of 5 years and there is no scrap value at the end, and you are supposed to apply depreciation on straight line basis. As a result, what you will do is 40 lakhs will be the initial investment minus the scrap value is 0, and you will be getting the amount of depreciation per annum based on life of 5 years as 40 lakhs minus 0 divided by 5 years, and that will be rupees 8 lakhs each year. Correct? Once you get the amount of depreciation, then you start making income statement and determine the amount of cash flows after tax. So let me show you how to present that answer. Let me show you the first working over here. That will be annual depreciation as per straight line method. It will be initial investment minus scrap value divided by project life. That will be 40 lakhs minus 0 divided by 5, and that comes to rupees 8 lakhs per annum. Let us move ahead and write up the calculation of annual cash flows after tax. Starting with sales less variable costs, what you get is contribution. From contribution you will subtract cash fixed cost and you get profit before depreciation and tax. From that you subtract depreciation, what you have just computed, and you get profit before tax as 12 lakhs. Tax rate is given as 30%, so tax amount will be 3,60,000. Profit after tax will be 8,40,000. Thereafter you add back depreciation of 8 lakhs and what you get is 16,40,000. Let us move ahead and take up one more example of this type, and here is that example. X Limited started a project which requires initial investment of rupees 32 lakhs. The project has life of 8 years without any scrap value. Depreciation is allowed on SLM basis. Amount of annual sales is rupees 2 crores. Variable costs are 80% of sales. Fixed cost other than depreciation is rupees 20 lakhs every year. Tax rate is 30%. Determine the annual cash flows after tax. annual depreciation as per straight line method, and that will be initial investment minus scrap value divided by project life. So your calculation goes this way. It will be rupees 4 lakhs per annum. I gave you 3 minutes of time to try out these calculations, and I am pretty sure that you must have already written this calculation, that is calculation of depreciation. That will be rupees 4 lakhs per annum. Now let us move ahead and look into the main calculation, that is calculation of annual cash flows after tax. Sales less variable cost should give you contribution of rupees 40 lakhs. Cash fixed cost is 20 lakhs, so profit before depreciation and tax is coming to 20 lakhs. Depreciation amount is 4 lakhs, so profit before tax is 16 lakhs. Tax rate is 30%, that is 30% of 16 lakhs being 4 lakh 80,000. When you subtract the amount of tax, the profit after tax is 11 lakh 20,000. Don't forget to add back the depreciation and you get annual cash flow after tax as 15 lakh 20,000.